Are you ready to start investing, but overwhelmed by all the different account options? Let's break down the choices and find the perfect place to grow your wealth. In today's video, we'll help you understand how to choose the right investment account for stocks market investing. We'll look at what makes each account special, what's good about them, and what's not so good. Let's get started to make smart investment choices. Let's start with a question. Why do you even need a special account for investing in stocks? Think of it like your toolbox. You want your tools organized in a place where they're easy to find and protected, right? An investment account does that for your stocks. It gives you tools to buy and sell easily, lets you track how well your investments are doing, and often offers special tax advantages to help your money grow even faster. There are a few things to keep in mind. Some investment accounts have fees attached to them, and there might be rules about how much money you can put in or take out each year. But overall, the advantages of using a dedicated investment account far outweigh any small drawbacks. Without the right account, investing in stocks would be messy, complicated, and you could even miss out on those helpful tax benefits. So, are you ready to find the perfect toolbox for your investments? Starting with the most popular options, retirement accounts. A retirement account is a special type of savings account. It's designed to help you save money for when you retire, that is, when you stop working. If your job gives you a retirement plan, it's a good way to put money into stocks, and maybe even in the company you work for. These plans get their names from parts of the US tax laws. The most common one is the 401k, which is a retirement savings plan mostly for non-government companies, but you might have a 403b, which is more for non-profit groups, schools, and some churches, or a 457 plan, mainly for state and local government workers. You add money to your account every time you get paid, and a lot of times, your job will also put in some money, which helps your savings grow. The money you put in can lower your taxes, and the money in the account grows without being taxed right away. You can also begin putting money into stocks by setting up an individual retirement account or IRA alongside your job's retirement plan, if you have one. IRAs offer tax advantages. You can pick either a traditional IRA, where you don't pay taxes on the money you put in, or a Roth IRA, where you don't pay taxes on the money you take out when you retire. Both types of IRAs have rules about how much money you can put in each year and when you can take the money out. Remember, investing in stocks through an IRA can be a smart way to save for your future, especially because of these tax benefits. It's like having a special savings account that helps you grow your money for when you're older. Now let's move on to the second type of account, which is a taxable brokerage account. Taxable brokerage accounts are like a regular investment account where you can buy and sell stocks, bonds, and other investments. Unlike retirement accounts, they don't offer special tax breaks. However, they give you a lot more freedom in when you can buy and sell your investments, and there are no limits to how much you can contribute. Also, if you prefer more flexibility, a regular taxable brokerage account gives you access to various investment options, including individual stocks, stock mutual funds, ETFs, and stock options. While they don't have the tax advantages of retirement accounts, they are more flexible and don't have contribution limits. You can also pick different taxable brokerage accounts as you seek a match for your investment style. Let's break down some of the most common options. If you want complete control over your investments, an individual brokerage account is the way to go. You'll make all the decisions and handle any tax stuff that comes up. The most basic type is a cash account. You can only invest with the money you have on hand. Want the potential to make more money, but are okay with a little more risk? A margin account lets you borrow from the brokerage firm to buy more stock, but be careful, because if your investments go down, your losses could be bigger too. With margin account, you can lose a lot of money if the market goes down, because the margin leverage works in both ways. You can make a lot of money, and you can lose all of your principal investment. So be very careful with leveraged margin accounts. The next account is good for investing alongside your spouse, partner, or another trusted person. It is called joint brokerage accounts. These accounts are shared by 2 or more people and can be either basic cash accounts or margin accounts for experienced investors. With a joint brokerage account, you and the other owners can all contribute money, make investment decisions, and have access to the account. A special feature is called joint tenants with rights of survivorship. This means if one of the account owners passes away, their share of the account automatically goes to the other owner or owners. This can make things much easier for your loved ones. Are you the type of person who doesn't have the time or experience to manage everything yourself? A managed account could be a great solution for you. With this type of account, a professional portfolio manager takes the reins. They'll select investments, buy and sell stocks, and handle all the day-to-day management based on your specific financial goals and how much risk you want to take. This leaves you free to focus on other things, knowing your investments are in experienced hands. So, isn't it time you found the right toolbox for your investment journey? Not yet, because we'll tackle accounts for specialized goals. You can benefit from tax savings when you use certain types of accounts for investing in stocks, especially if you're saving for specific purposes like education or healthcare costs for yourself or your child. It's helpful for you to look at these options because they offer special tax benefits. First is Dividend Reinvestment Plan accounts, or DRIPs for short. Here's how it works. Some companies offer you the option to reinvest the dividends you earn from their stock. Dividends are like little cash rewards for owning shares. Instead of getting that cash, a DRIP automatically uses it to buy even more shares in the company. This might sound small, but over time, getting more shares and more dividends can really add up. It's like compound growth in action. And the best part? Most brokers won't charge you fees for these extra share purchases. Second, education savings accounts, or ESAs. When you put money into this account, it's special because the government doesn't make you pay extra taxes on it, as long as you spend it on things you need for school. This can include things like tuition, books, and other important school supplies. ESAs are a smart way to invest in a brighter future, ensuring you have the resources to support your child's educational journey or even your own. A famous ESA account in the US is a 529 college savings account that you can open up with most brokerage firms, such as Charles Schwab, Vanguard, and Fidelity. A 529 college savings plan is a state-sponsored investment plan that enables you to save money for a beneficiary and pay for education expenses. You can withdraw funds tax-free to cover nearly any type of college expense. 529 plans may offer additional state or federal tax benefits. Let's move on to Health Savings Account, or HSA. Are you worried about the rising cost of healthcare? Think of an HSA as a special piggy bank for your medical needs. The money you put in isn't taxed, so you get an immediate savings boost. Even better, the money in your HSA grows without being taxed. And when it's time to pay for qualified medical costs, like doctor visits, prescription drugs, or hospital stays, you can take money out of your HSA tax-free. This double tax benefit helps your money stretch further when it comes to your health. Sometimes, you might want your investments to benefit someone else or need help managing your accounts. Trust and custody accounts offer solutions. With a trust account, a designated person, the trustee, manages the investments for someone else, the beneficiary, which can be useful for providing for loved ones or passing on your assets. Custody accounts are designed for minors. While a child can own stocks and other assets, a custodian handles the account and makes investment decisions until the minor reaches adulthood. Now the question is, what are the major platforms to open an investment and trading account with? The main brokerage firms include Charles Schwab, Fidelity, E-Trade, Vanguard, Merrill Edge, and Wells-Trade by Wells Fargo Bank. You can visit their websites to open an account online. It is recommended that you examine their trading fees and compare them. Information about their fees is also available online. Let's wrap this up. Choosing the right investment account is a key step towards achieving your financial goals. Whether you're saving for retirement with employer-sponsored plans or IRAs, seeking flexibility with a taxable brokerage account, or investing for specialized goals with DRIPs, ESAs, college savings, or HSAs, understanding the different options available will empower you to make informed decisions. The range of accounts, from individual and joint brokerage accounts to managed accounts, ensures there's an investment toolbox perfect for every investor. So, after watching this video, do you feel confident in choosing the perfect investment account to start your stock investing journey? Don't forget to support our channel by liking and subscribing to this video. Turn on those notifications so you'll always know when we release new content to help you reach those big financial goals. Thanks for watching, and see you in the next video.